Hello traders, I am happy to be back with another video on liquidity pools and stop loss hunts. So this is something that I've talked about for years. I've even written a book on called Gravity. But what I want to talk about today is how it affects the current market in crypto. Let's dive in. So first example on Bitcoin, I want you guys to look at each horizontal line here. It represents a point of resistance or support. And then look at the circles where stop loss hunts happened. That's where price went a little bit above that line or a little bit below that line and then quickly reversed. This is something that happens very, very often on Bitcoin, as many of you probably know. So with the recent all-time high, I want you guys to look at the price action. Price made a consolidation at on the 9th to the 10th. Do you guys see that? Horizontal line at 66,295. Now, a lot of traders probably put their stop loss right below $66,000. That would probably make sense, right? If price goes below there, you think the price would fall. But here's what ended up happening. As you can see, price went right below 66K, hit a lot of people's stop losses, and then went right back up. So how could you have avoided this mistake and exploited it even? Well, if you're a trader who's bullish on Bitcoin in the short term during this circumstance, and you know how markets tend to run, it'd probably be wise to put limit orders right below support, right below 66K, so that you can get all of the retail liquidity as they sell on to your bids. That would be probably one of the better ways to go about this. And then, as you can see, price made an all-time high, and then went hurtling to the ground. And then you see this pattern time and time again. I don't want to talk about all of them, but the 62,400 point where price went a little bit below, then went right back up. This is quite common. And it's not just Bitcoin that does this. You can see it on Solana right there. This is something that if you're not aware of or you're not exploiting, then you're probably going to be exploited if you do use stop losses or if you just trade manually with buying and selling whenever you want. You have to understand that a lot of times the best time to enter is when there's a lot of volatility and price seems to just be hitting everyone's stop loss and hitting everyone's liquidations. That's typically the point of best risk reward. Here's another one, Shiba Inu. If you look at Shiba Inu, you can see on FTX, you can see multiple times, I mean, there's a lot more than this, of course, but just multiple times where people's stop losses got hit and then price went right back up. So, that's something that, and XTZ, there's so many on this that I couldn't even circle them, but just about every single move on this coin has been a stop loss on. And it would be very, very, very profitable if someone basically just shorted whenever price went above a local high and bought whenever price went below a local low. That would probably make a fair amount of money, just because of how many stop losses XTZ has hit. So let's talk about this instead of just showing examples. So typically stop loss hunts are where beginning traders exit and veteran traders enter. Now, a lot of you guys who have watched a lot of my videos probably already know this, but of course this video is going to give examples for traders who already are aware of liquidity pools and stop loss hunts, and also the traders that have no clue what I'm talking about and want to learn more about stop loss hunts. So what really ends up happening is some traders are forced to be liquidated, their stop losses hit, and a fair amount of panic can happen, especially when price goes right below a local low and you see price hitting stop losses and liquidations. That can cause a lot of panic, and when a lot of traders see escalating lower prices, they tend to make mistakes like selling because everyone else is selling. FOMO can happen, fear of missing out, if price hits a lot of stop losses, a lot of liquidations right above a local high, kind of like the Bitcoin example from, where was it? Here, perfect. The one that happened at $69,000, where price went right above, hit a lot of liquidations, hit a lot of stop losses. We had a lot of FOMO, so people buying the top. This, of course, was the best possible time to sell in short. So you should know that an escalation of volatility at a point where a lot of retail traders are probably making poor decisions typically means that it's a good time to enter a reversal trade. So as I said, price tends to be more likely to reverse from high volatility, not just specifically any high volatility, but high volatility that's stopping out traders, that's causing a lot of traders a fair amount of pain right beyond resistance or right beyond support. Now, of course, this doesn't always happen, and some of the best traders are able to differentiate a genuine move where price is trending higher and higher and higher, or lower and lower and lower, versus a stop loss hunt. And if you're worried about, hey, what if this is a genuine move, or what if this is just a stop loss hunt? One of the better strategies that I found is to buy calls or buy puts when these happen. So what I mean by that is, when I don't want to get into what options are, but basically buying a put is a bearish move, meaning you think the prices will fall. Buying a call is a bullish move, meaning you think the prices will rise. And when you do that, you are limited to a fixed loss. So you can't lose more than something called your premium. So if price goes right above a local high, and I'm thinking the price is probably going to fall, but it could also skyrocket higher, a move I could make would be to buy a short-term put, such as maybe like a weekly expiring or one that expires in like 10 days, hopefully at a lower implied volatility. And if price just continues to trend higher, I lose the premium. But if price quickly reverses with that quick volatility, that could increase implied volatility, and with a quick downward move, that could make me a fair amount of money, because the put would become deeper in the money, or just increase its probability of being in the money. So that's one of the safer ways that you can trade them. And if we look back at some previous examples, let me go back. Some previous examples on Bitcoin, you can see, of course, if you had bought calls at 62,400 when Bitcoin was at 62,400, or bought puts at 69,000, that probably would have paid off really well. And even if you had bought a put at the price of 66,300, on the far left part of the screen, on the 8th day of this month of November, you can see the price made a little stop loss hunt where it went a little bit above, then went back down. Even if you had bought a put there, if it had been a put that expired in 1 week, it probably still would have made you money. So typically, as you can see, the best time to enter is when a lot of people are getting hurt, or is when a lot of people are getting stopped out. Another way you can do this is to trade spot. So such as BTC USD instead of BTC perp, of course, that would be another way to do that. So here's a quick example, because I'm trying to keep this video under 10 minutes to keep it more bite-sized. What would you do in this opportunity? You want to invest in Solana, let's say. Where's your price point to enter? Is it right below 140? Do you want to enter right now? Is it right below 120? Where's the premium point? Where's a price point that, if reached, everyone's stop loss would be probably hit? Here's the best place. Price went right below 120, stopped out a bunch of traders, and went higher. Also, the price point on the 6th, where we had that crazy candle, right? That was a very, very high volume candle. It was actually the highest volume candle on the entire chart. So going below that is probably going to hit a lot of retail traders' stop losses who maybe bought during that candle. So that's another thing to think of, is how much volume was generated near those lows, meaning, how much retail liquidity is probably going to get taken. Yep, price went higher on Sol. Aave, what would you do here? Would you want to buy at 297 or on Coinbase, or do you think that not enough retail traders have been stopped out and there's a better price point to enter? I'll give you guys a few seconds to try to answer this one. So price actually went right below and hit a bunch of people's stop losses at about 250. So buying at 293 versus buying at 250, it's a pretty big difference, even when you're investing. Now, yeah, again, this is just another example of price consolidating, and that price typically likes to test the lows, i.e. hit a lot of people's stop losses before reversing. So a lot of traders who had bought on Aave, who bought on Coinbase, bought Aave, they might be putting their stop losses around 260, 250, and they get hunted, just like that at the circle. So what you need to know is that, of course, I've talked about this in basically every video, but there are a cycle of market emotions, and you need to be able to differentiate yourself from the herd by really doing the exact opposite of what they're doing. So if a lot of retail traders are placing stop losses right below a low, it might not be a terrible idea to buy where a lot of retail traders' stop losses are, if it's below a low. And if a lot of retail traders are retail shorts are putting their stop losses right above a local high. Price hits that high, goes higher, and then a bunch of people start buying in, then that's probably a good time to buy puts or to exit a long position, of course. So here are some just final tips on investing if you want to really take advantage of retail liquidity. First, identify the price point where many traders are probably going to be forced out of their positions. If you want to exit a position, remember that typically the best time to exit is when the majority enters. And try to almost never place your stop losses in a price area that was just right above a high or right below low, because that's where everyone else is probably putting their stop losses. As you know, if you want to be a successful investor or a successful trader, you need to constantly just try to do the opposite of what the majority are doing, or at least try to position yourself before they do. So if you think a lot of people are about to buy, we want to buy before them, but if a bunch of people have already bought, we typically want to sell. That kind of framework is probably going to put you ahead of 90% of traders. And just from this video, if you remember anything, remember that if price is consolidating, typically the best time to buy is when price goes right below those lows, right here, and then you buy, and then typically, price will either go much higher, or at least if price continues to fall, you're still buying at a better price point than you were if you had bought higher in consolidation. So remember, don't place stop losses in obvious areas, and try to take advantage of other traders who do, because there are always suckers who are going to get forced out of their positions like that, like that, and like that many times. So with that, happy trading, and go mark up your chart to get better entries.